We're going to get started. Hello, everybody. For those of you who don't know me, I'm Maggee Miggins. I run the Maggee Miggins group at Compass Real Estate. We've been selling real estate for, since the 90s, 95. And we are a collaborative team that work together. Our offices are located right at across from the Short Hills train station. We're right next to the post office, so please stop in. We'd love to see you at any time. We're very excited today, and oh my gosh, what timing. The Fed raises interest rates 3/4 of a point yesterday. We have with us today Steve Firestone, and he is an assistant teaching professor of finance and the director of Master of Science in Finance program at Drew. So his research focuses on market and credit risk, fixed income valuation, behavioral finance, and real estate economics, which of course we're always interested in. Prior to joining Drew, he served for 7 years as US Treasury official in the Office of the Comptroller of the Currency. So he provided oversight of institutional trading and lending activities at some of the country's largest banks. So I think that's kind of cool. 20 years in government and the financial markets as well as fixed income trader, portfolio manager, investment banker. You currently serve on the Site Plan Review Board, Advisory Board in Princeton, which is close to my heart. Any review board to serve on, and you were on zoning in Hoboken and planning and zoning in Charlotte, North Carolina. So you really love that stuff, and that's all volunteer, I want you to know. He received his BA from Bucknell in economics and MBA in finance and public policy from Indiana University, and you're working towards your doctorate of business administration at Drexel. You have a CAIA designation, and you're active in that foundation, which is Chartered Alternative Investment Analysis. You'll have to tell us what that is. And the International Association for Quantitative Finance, Commercial Real Estate Finance Council, and you like to run. Well, that's very impressive that you have completed 2 marathons?
So far.
And those are the New York City marathons?
Yep, number 3 is coming up this year.
God bless you, because that really requires a huge commitment, and it's a daily. You work at that 6 days a week, I guess, right? Don't you have to give your body 1 day of rest?
Yeah, usually at least 1 day of rest. So you ramp up your mile intake from about 20 miles a week to about 40 miles a week, and you know how you squeeze it in is whatever your schedule works for. And sometimes you need a day of rest, sometimes you don't.
Whatever it takes, I guess.
Whatever it takes, right? Whatever
it takes. Well, good for you. I'm always in awe of people that can run 26.5 miles. And I always think, you get to three-quarters of the way through, and that's probably where you think, oh, I can't do it. And then boom, you push through. So, and the crowds that help, I guess. So I'm very excited. I'm going to turn the camera over to you and the slides over to you, Steve. And what I've asked everyone to do who are on the call, if you have questions, don't hesitate to put them in the chat box as Steve is speaking, and we'll circle back and try and answer those as well. But take it away.
Fantastic. So I'll get started with just to talk a little bit about our topic for tonight. We're talking about real estate markets and where they're headed. So I thought it would be a good idea, as far as how the presentation goes, to talk a little bit about kind of the broader economics and what are going on today, things that are obviously hitting the news every half an hour, it seems, in the last couple of days, but then also try to relate those to the real estate markets. I'd like to thank the Maggee Miggins group of Compass Real Estate and Short Hills for bringing me on and inviting me to speak tonight. I'd love to be able to continue this relationship with them, and we obviously have a very common interest in real estate markets, so I appreciate their kind invitation to come and speak tonight. As far as disclosures go and disclaimers, if you will, the views that I'm representing here are my own. They're not related to Drew University in any way, of course. And I also make, as my students that may be joining tonight well know, very heavy use of Bloomberg charts and graphs, in order to explain points that I'm trying to make. Bloomberg is a terrific data source, and we use it pretty heavily in the Masters of Science in Finance program at Drew. Drew University is about a 2,000 1,000-person liberal arts university and based in Madison, so not too far away from the Compass offices. We specialize in a number of things, but our largest major on campus is business, and then one of the top 10 majors is finance, economics. So you'll see a lot of folks at Drew who are interested in business, who have an interest in real estate, and we'd certainly love to continue that down the road. So just as far as next steps go, Maggee was doing a great job of introducing me to the group on CNBC. They typically do a little segment on people that are speaking called street cred. I guess it's their street credibility. So I think Maggee mentioned just about all of these things. I've served on a number of local planning boards, zoning boards, in addition to being heavily involved in the industry, including running a trading desk through the great financial crisis, which was amongst the most interesting times to be related to real estate and to be trading real estate related securities. One of the things that you may all not know is that I went and sat for my real estate exam when I was 17 years old. Both my parents were and still are to this day professional realtors, and they made me sit for that exam, which I thought was not a great idea at the time, but came to realize that it was just kind of one step that helped me kind of foster my interest in real estate, finance, and economics that would be used down the road. So in terms of where we are today, I'm sure some of you have caught the news. I updated this slide as of yesterday, so it doesn't necessarily include all of the downdraft that we saw today. So just in terms of the overall kind of market conditions, the S&P 500 stock index is down 23% or more this year. It was kind of flirting with bear market territory, which is down 20% a couple of days ago. And then we had a bit of a rally when the Fed came out the other day and decided to raise interest rates by 75 basis points. But then today you saw a continuation of the selling. So I think the S&P 500 was down another 3% today, 3% and change. The NASDAQ, which is traditionally thought of as one of the more risky parts of the stock markets. It concentrates primarily on technology-related companies. That's down 32% year to date, which is a pretty radical move for any given period of time. So we can talk about kind of the reasons behind that perhaps later and in the Q&A session. The idea for tonight is that I have some slides and presentation materials. Generally, I'm expecting them to consume maybe a half an hour's worth of time and kind of open it up from there to dialogue, to questions. You all, many of you are professional realtors, you're in the business every day. So you interact with clients, you have things that come up, you have things that you see that I might not be seeing just looking at the aggregate data. So I really appreciate your feedback and would obviously love to hear from all of you at the end of the presentation. So the S&P 500's down, the NASDAQ's down even more. And then if we look for things like cryptocurrencies, I think as of today, it was down about 57% year to date, if not more. But as one of the commentators I saw on TV was talking about earlier, we've seen crypto move in kind of 70% or more in any given period of time over the last bunch of years. So it's not actually that unusual for crypto to be volatile. One of the things that I've heard discussed a lot in the news recently is, whether or not this is a long-term capital moment or a Lehman Brothers moment for cryptocurrencies. So I don't bring this up necessarily because all of your clients are out there coming in from California and saying that they want to buy real estate in Short Hills with cryptocurrencies. I bring it up more from a perspective of how it influences consumer psyche and whether you are a person that's earning a more modest income and you're looking for like a conforming mortgage, or whether you're a multimillionaire that's looking for a different type of housing in New Jersey. All of you will consider kind of what's going on in the market activity and the buzz that you hear around you, and may kind of change your risk profile and preferences based on that, what you're hearing. So, what have we seen so far? Just the other day, the University of Michigan consumer sentiment numbers came out. So most economists think that this is a leading indicator for business activity. And I pulled up a chart here going back to 1977, which is the longest time series I could construct. And it's pretty much at the lowest of any of the time series out there. There were obviously some lows that occurred prior to, or during the Great Financial Crisis, 2008, 2009. There were some bumps in the road that we hit in 2010, 2011 with different sovereign debt crises that we're dealing with. But then markets started to rebound quite significantly and consumer sentiment was up. So just in the last, since the pandemic started, you've seen a pretty steep drop in consumer sentiment. So the first drop that you see, where it kind of went from 100 down to about, 78, you could attribute most of that to the pandemic. But what we're seeing after that in more recent days and weeks and months is really probably something a little bit different. And that might have a reflection on, what the consumer feels about any sort of, getting into any sort of assets, whether it's real estate or something else. So why does everybody feel this bad about the economy? There's a bunch of reasons, and you probably see them in the papers that you read every day. One of them is obviously inflation. So on a non-seasonally adjusted basis, the year-over-year inflation numbers are pretty much running on all cylinders. We're hitting 40-year highs for inflation, which is represented as the consumer price index in the United States most heavily. So we just came over, I think it was 8.6% is the most recent read on inflation. That's obviously higher, the highest number that we've seen since, kind of the early 80s and late 70s. There was obviously a dip after the Great Financial Crisis where you actually had a lot of people concerned about deflationary assets. But now we seem to have a problem of inflation that is more than transitory, which was the initial kind of language that the Federal Reserve and others were using to describe it. It seems to be that we've got a bit of an inflation problem, and the next thing is how do we solve it? So if you look at inflation, it's not just food and energy that's concerning people. So this is the graph I created in Bloomberg from what's called core inflation, which is excluding food and energy. And you can see that even without food and energy included, there's been a spike, and a fairly significant spike in terms of inflation. We had this kind of Goldilocks period for the last 20 years or so, where we were just humming along at 1 to 2% inflation. Now we're looking at a very different story, and that's something that's actually causing, I would say this chart probably caused even more concern at the Federal Reserve than some of the others, where you look at the headline inflation numbers, because to them, these inflation readings are a lot more broad-based. So it is 6%. It's not 50% inflation, thank goodness, but it's still enough to cause a lot of concern when the target rate of inflation is probably 2 to 3% per year, according to the Federal Reserve and what they're trying to do with monetary policy. So it's kind of the broad-based nature of inflation. Also, if you look at some of the producer price indices, which are made up of kind of wholesaler numbers, you'll also see an even more pronounced rate of inflation. I think PPI was running closer to 10% year over year in the most recent readings, but it's certainly enough to cause concern, and it's certainly enough to think that we may have a real problem on our hands.
Can I ask you a question?
Yeah, go ahead.
When you say that 6% and it's got nothing to do with the energy, what is that 6% then? When we're used to having it around 2% or 3%.
Yeah, that's
that big spike up. What is that?
Yeah, actually,
what are those ideas? What are those things?
That's a great question. I think CNBC actually did a good article today on that actually breaks down, what the different components of inflation are. I think one of the points they were trying to make is that you're actually seeing quite a lot of services related inflation. So whether that's the person that's, mowing lawns, the person doing babysitting, it could be housing related inflation also, because the core rate does include housing and rents. So there's a lot of things that could be causing it and driving it higher. But it really was, kind of a broad print, as we would say in the industry, and that's what's been the most concerning. I think we are all probably pretty familiar with what some of the issues are with the energy crisis and why, prices for energy might be abnormally high due to, kind of large geopolitical shocks that have occurred, especially in the last, 6 months or so. But you started to see inflation tick up prior to the Ukrainian crisis, and so that's what's really concerning to Fed officials, and that's why I think you saw a very aggressive move in terms of 75 basis points of correction earlier this week. The Federal Reserve has not raised by 75 basis points in a single session since I think 1994. When they were also kind of trying to shake some of the excesses out of the market at the time.
Let me ask you another question while we're on that. With the Ukraine war and oil, etc. Let's just say we wave our magic wand, God willing it does, and that war ends. Okay, Russia, everybody takes their bats and balls, they go home, they come to an agreement. How quickly, or does it even happen, where the rate of inflation might fall based on the fact that there's then peace in that region?
That's another great question. I think that we could see kind of the headline inflation numbers fall pretty quickly if there is some sort of resolution, to the Ukrainian crisis. You also have some other kind of issues that are working their way through the system in terms of certain kind of G10 countries trying to become less reliant on fossil fuels. Certain G10 countries kind of trying to go away from nuclear power. So these things can't be built overnight necessarily. You can't necessarily do exploration overnight. But I think it would have, like you are seeing some gapping right now in terms of the energy prices. And I don't think you would see that if the Ukrainian situation was resolved. I think you would see a more orderly market, if you will, that would occur.
Okay.
So, yeah, excellent. So just to flash back to some of those of you that might be familiar with like the 1970s in this country, there was in the early 80s, there was something that an economist created called the misery index, which is a combination of inflation plus the unemployment rate. So as you can see, where we are right now in terms of inflation, certainly high, and it is certainly high historically. Since the early 1980s, we haven't seen inflation this high in the United States. But the misery index isn't quite that high, and that's part of a reflection of the second part of that equation, which is the unemployment scenario. So we're not quite at the same point as we were in the late 70s, early 80s in terms of the misery index. And I think that might well play into real estate values over the next 12 months.
How so?
Oh, I'm getting to it.
All right.
I'm getting to it. Just to kind of break the number down a little bit more, the U.S. unemployment rate. For any of you that have been out like running small businesses or even running large businesses, you probably find it very difficult to hire people since the pandemic. There was a point during the pandemic or right after it began where the United States reached, I think it was close to 15% unemployment. And that's a level that we have not seen since the Great Depression, as far as I can recall. We have seen higher periods of unemployment in this country, the early 80s, and then after the great financial crisis was an obvious one. But then, we settled back down very quickly to more of what you would consider to be a normal rate. So most economists think that, kind of a 4% to 5% unemployment rate is normal. It reflects a certain amount of transition that's occurring in the economy, where you might have a job seeker that's transitioning to a new job. They might be unemployed for a period of time to do that. So it's kind of like what you would consider to be the normal transition timing for a market economy. And then obviously there's some issues with it in terms of leaving out as a measure people that have been, have stopped looking for employment. So that's obviously one of the fixes that would eventually be made to this measure. But as you can see from this chart, we're still running at under 4% unemployment, which, like I said, if anyone has tried to hire anybody recently, it's really challenging. So, what does that mean for real estate? That has traditionally been a strong advantage to real estate. Two of the biggest things that I would say are tailwinds for real estate tend to be the unemployment rate, which is when it's low, real estate tends to be able to sustain value. And the other is incomes. And if you look at kind of the wage data in the United States, you will see wage inflation kind of picking up at the same time that inflation in other categories is also picking up. So these are kind of things that do kind of put something of a backstop into real estate that might not be there for some of the other asset classes that I mentioned earlier, whether it be crypto or the NASDAQ 100.
Okay.
So nationally, where have home values been and where are they going? The Case-Shiller Index is probably the one that the most people are familiar with. It's the one that gets cited in most of the news articles where you talk about the real estate markets. It's a repeat sale indicator index, which allows you to try to get a sense for the actual price changes in a specific property over time. So in 2007, we obviously kind of topped out nationally for the Case-Shiller Index, and then started a kind of a smooth decline into 2012. And you can see, kind of going after that, we've had just a very, very rapid buildup in home values. There was an interesting article in the journal, I think it was today or yesterday, about the amount of home equity that people have right now is pretty extraordinary. And that might be one of the things that looks a little different today versus what you might have seen perhaps in the last, prior to the great financial crisis, when there was a significant run up in real estate values. So there was kind of a wealth effect that people had, but there was also, a really tremendous amount of like home equity borrowing that people did on the back of that to try to tap that home equity value. So
you can't, I don't believe you can use that as a deduction anymore, home equity and interest deduction. Isn't that correct?
Yeah, I think you might be right on that in terms of using home equity in, I think it was the 2000 and it was either 2019, 2020. It was in the last administration. There was a law passed that kind of capped the amount of local tax deduction you could have, which particularly had a hard impact on the greater New York City area. I think it capped real estate deductions at something like 10,000, which if you've shopped for a home anywhere in some of the hotter markets in New Jersey, you know that maybe that's half your tax bill. So sure. It definitely took away one of the kind of key advantages to real estate, and there isn't, and definitely the home equity advantage is one of them. And then, just as far as like the New York City area goes, as far as Case-Shiller looks at it, probably most of you saw articles about how the New York City market, everybody was leaving. There was, you had to have all these kind of rent concessions. Landlords were typically offering 2 to 3 months of rent concession. And then all of a sudden, a change happened where a lot of people realized that they wanted to be in New York City, or they wanted to be kind of in a more urban area. And like I said, just looking at the anecdotal evidence of traffic on the New Jersey Turnpike, it looks like quite a lot of people are still thinking that urban areas have some staying power. And what you've seen in New York City markets, especially, is that real estate's just been on a tear. It's been very difficult to find affordable housing. The majority of the housing stock that got built in New York City, post the great financial crisis, was tended to be more on the luxury end of the spectrum. And we can talk about affordable housing kind of later in the presentation, but that's one of the kind of key empty spots or gaps that we've been trying to fill that we've not been very successful at since the great financial crisis. And it might create something of a demand floor for real estate in this area for the next bunch of years. So the big thing that's happened, obviously, and this is a lot induced by the Federal Reserve activity, has been the shape of the yield curve. So mortgage rates don't follow directly to the yield curve necessarily, but they do tend to mimic some of the long end of the curve. So if you look at kind of the left side of the chart, that's the stuff that the Federal Reserve can influence the most. Right. So right now we started off the year at almost 0% interest rates for short-term borrowing. So I think we're now over 1, and a lot of people are calling for a terminal Fed funds rate of somewhere between 3.5% and 4%, which would be a pretty steep increase even from where we are today. So a lot of people are concerned that there are several more Fed hikes to come. They could be 75 basis points or more, and that we're at least 50-50 right now in terms of the probability of the United States going into a recession over the next 12 months. So the yield curve obviously looks quite a bit different than what it was when we started the year. And that's had a very material impact on mortgage rates. So not all borrowers choose to use 30-year fixed rate mortgages for their real estate purchases, but it is one of the key benchmarks we follow because a lot of folks do tend to lock that in. It tends to be the most conservative way to purchase real estate if you have the ability to, either in 15-year or 30-year form. So what's happened since the beginning of the year is that the 30-year fixed rate has essentially advanced from about 3% to 3.25% to even this slide is now dated. I've heard that the 30-year fixed rate mortgages have actually jumped in the last 48 hours to 6.25% at some borrowers. So we've had a nearly 300 basis point move in 30-year fixed rate mortgages just in the last couple of months. That certainly is going to have an impact on, kind of your marginal real estate buyer, meaning that the person that might have been, trying to, afford, a payment. Maybe it's, instead of being 40% of their income, they're going to have to devote 50 or 60% of their income towards their real estate expense, which is, to most like financial procrastinators, kind of an unsustainable position. It's a lot to be spending on real estate, in light of, kind of, your consumer spending habits. So what some borrowers have tried to do, and you've probably seen some articles about this in the past, few weeks, is that, according to the Mortgage Bankers Association, there's been a real uptick in the percentage of adjustable rate mortgages that have been issued as a part of overall mortgage originations. So you can see it's about 8% now. It had dropped to, I guess it was around 4% during the 2020 period. But you can see when we're comparing this going back to the great financial crisis, meaning 2005, 2006, the lead up to that, there's nowhere near where you have like the 35% of your home buyers coming in with adjustable rate mortgages. A lot of folks will see adjustable rate mortgages as a way to lower their initial monthly payment. And then, with the idea that perhaps they can refinance, 1 year, 2 years, 3 years down the road at a lower rate than they could today. But it also makes the home purchase more affordable kind of right out of the gates. And then you'll have some home equity that builds up that can help you, deleverage that position in years to come. But, I would say one of the pieces of good news is that while the ARM volume has increased pretty substantially in the last couple of weeks, this really is nowhere near what you saw in terms of, the events kind of preceding the great financial crisis.
Why is that?
Well, I think that there was a much greater willingness on the part of lenders to extend interest-only loans and extend, adjustable rate financing prior to the great financial crisis. A lot of the banks and financial institutions learned a very hard lesson during the crisis about some of the what they considered to be affordability products that they were extending, whether it be the ninja loans, no income, no job type of loans. I think a lot of banks kind of improved their credit standards after the great financial crisis, so you don't really see quite the same volume of the riskier kind of lending activity from the bank's perspective coming out of the last couple of years that you saw kind of preceding the great financial crisis.
Okay.
So the MBA also produces a lot of other good information. The non-seasonally adjusted purchase index, also nowhere near the great financial crisis or preceding the pandemic, but also in pretty bad shape and potentially going in the wrong direction. When you do seasonally adjust it, though, it's actually not quite as bad as you would think of in terms of the purchase prices that are going into properties. We aren't kind of where we were yet in terms of 06, 07. We have kind of increased since some of the lows, but it's not when you actually adjust for the seasonality, which I think just about everybody who's in real estate knows that there's a seasonality associated with the real estate sales process. It's not quite as bad in terms of the valuation as others might think. So one of the other kind of data components that I look at is the National Association of Realtors data. They use the MLS database to do existing home sales. So the point I would make from this is that you saw existing home sales top out at around 2005, started coming down in 2006. Most people realize that that's actually preceding some of the really radical events that happened in the great financial crisis, like Bear Stearns and Lehman Brothers, et cetera, which happened closer to 2008. So in this case, the MLS data was a little bit of a leading indicator prior to the great financial crisis. So one of the points that I'd kind of submit to you all, is that real estate is an asset. It tends to be the largest asset that any individual will purchase throughout their lifetimes. It isn't something that usually flies off the shelf within a day or two. All of you that are involved in the market know that it takes more than just putting up a listing on MLS to sell a home. It's a very important financial purchase. It takes marketing, it takes research, it takes discussing it with clients and dealing with issues that they have. Whether it's a dated kitchen or even paint, something as simple as that. But there's more to it than necessarily, kind of putting it up on MLS and then, a week later, you've got 30 offers on the property. And that's the period that we've been in for the last bunch of years. Part of that is a result of the fairly easy monetary policy that the United States has had with very close to zero interest rates for a prolonged period of time. So are we cooling, or is this kind of actually a reversion to what I would consider to be a more normal kind of real estate cycle? In normal real estate cycles, it usually takes 2 or 3 months at least to sell a home. In normal real estate cycles, you have more than a month's worth of inventory available to prospective buyers that are looking. My guess, and I'd love to hear comments from people that are in the business right after these slides, is my guess is that you're still facing fairly tight inventory levels right now. And even though people might be a bit more nervous about a home purchase now, and they might be concerned about 6.25%, 30-year fixed rate, they still need housing. And they still have to work where they need to work. They still have to be able to find shelter in a place that they like. They have to be in a community that they like. The educational component of the community is usually paramount, especially in New Jersey, where we've got great public schools. So I think what we're reverting to is a more normal real estate market. So if you came into the real estate market late and got your license perhaps 4 or 5 years ago, and you thought that what we were seeing was normal, it's probably not. That's probably an anomaly that we're not going to see again for a period of time. But does that mean it's necessarily a bad market to be in? And I would contend with you that it's not a bad, from either an investment or a shelter decision to be owning real estate over time. So one of the things I was telling Maggie the other day, I was attending the Commercial Real Estate Finance Council conference earlier this week, and got to hear a lot from different participants in the markets, especially those that are financing, real estate, whether it's multifamily, whether it's industrial, office space, et cetera. And there are still a lot of areas in those markets that are challenged. I mentioned retail and office in particular for different reasons. But one of the things that there was a lot of consensus around is that the multifamily trade, if you will, of financing multifamily properties had kind of run its course, meaning the cap rates, which is kind of like a reverse of a price earnings ratio for those of you who aren't as familiar with it, meaning the lower it is means the more expensive it is. We've kind of hit pretty low levels on capitalization rates. I think if I ran this chart back, another 10 or 20 years, you would see different periods where it kind of touched on 5% for multifamily. But, the other thing is that one of the other concerns that I heard at the conference is, well, where are you going to go with new capital? What are you willing to finance, tomorrow? And the thing that I heard over and over again from investors is what they were looking for is, I'm looking for properties that can have cash flow growth that exceed the inflation rate. So where am I going to find that? you're going to find that, I'm guessing, for any of you that have done rental properties in the last couple of months, I'm guessing that you've seen increases in terms of any sort of leases that were rolling over. Maybe they were 10%, maybe they were 20% or more. And that's for, suburban New Jersey. I would submit that there are places in New York City that you can see wildly higher than that. So, there still is a lot of capital dedicated to multifamily, and if no other reason, that it's the one area that large investors are still thinking they can get, kind of better cash flow growth than they're seeing, given an 8% or 9% inflation rate. So the one thing that I wanted to point out is a little bit of a concern is the level of household debt. We've especially in the last couple of years, students that have taken, some of my courses will know I show a lot of slides on like what the total US government debt has done in the last 5 to 10 years, especially. We've seen really meaningful increases. What I think about most when I'm thinking about, though, the consumer and the consumer being able, especially to finance a real estate decision, is like, how does debt figure into their household? So this is a chart of US household debt to disposable income. So disposable income meaning, after we pay our rent, et cetera, things like that. And you can see that the consumer is kind of getting crunched. They ran up to this place during the great financial crisis where they were easily had more debt than they had disposable income to kind of pay off. And that cycle did revert down, but you're still seeing it at a very difficult place right now because, the consumer just doesn't, with rising rents, they've got rising gas prices, rising prices in just about everything. They don't have a ton of disposable income anymore. So, potentially this could be a crisis down the road. I'm not sure that this becomes a crisis in the next 6 to 12 months, but one of the things that I think that we're going to start talking about a lot more in the next 5 years or so is how much debt we have nationally, and then what we might be able to do to kind of lower debts for consumers at a more, kind of direct household level. So crystal ball, none of us really have a really good crystal ball. But I thought I might kind of take a stab at it based on some of the things that I've seen so far on the markets, and welcome your feedback and thoughts and questions in the chat. In terms of the New York City metro real estate markets, I don't think real estate's going to be flying off the shelves in the same way that you've seen over the last couple of years. It requires marketing and online stuff, and you'll know that the consumer has kind of shifted back and forth in terms of what they need. You've seen some online services come up and then not do well, that would offer things like 2% commissions or 3% commissions. You've seen Zillow try to actually, kind of manage the home buying decision by purchasing properties, and then they actually got out of that business not too long ago. The one thing that I think that dislocated markets really emphasize is expertise. And it's very difficult to know kind of where a large asset like a home should be trading if you're not getting expert opinion on it. So to some people, there's, one of the things that I found during the great financial crisis is when there was very little difference in terms of what, I was on a trading desk at the time, and there's very little difference in terms of what dealers will pay, whether it be 1 basis point or 2 basis points on a particular bond offering. They don't really value necessarily expert advice on things. But when markets do become dislocated and, people don't have as many options, and they're trying to figure out, okay, where should this be? Where is it going? They do tend to rely on expert advice a lot more than they would during very tight markets when they're getting 30 offers for each property. So I don't think real estate markets in the New York City area will correct more than 0 to 10%. If history is any repeat, especially during the great financial crisis, the real estate market prices held up much better in the tri-state area than they did in some of the hot spots around the country, like Phoenix and Las Vegas, et cetera, areas that got very overbuilt in front of the great financial crisis. Real estate firm hiring is obviously cyclical. A number of people probably have seen news this week about Compass, about Redfin, other real estate firms, potentially downsizing a bit. I would say that in a market where there are 30 offers for every property, maybe relationship is not the most important thing, but if you're in the business for the long term and you want to make, real estate your career, I would say relationships are the things that you need to invest time in. They do wind up paying off. Just coming up in a real estate household as a kid, I heard more than enough stories about how somebody knew somebody from somewhere else and they had a positive, opinion of, one of my parents, and they trusted them, and that helps to build a bridge for somebody that's trying to make what might be the most important financial decision of their lives, which is buying real estate. So household formation is still not absolutely recovered since the great financial crisis. A lot of, we have not built enough homes, and there's a whole bunch of different reasons for it. But, where are those people going to go? So even if you do see some amount of attrition in terms of the demographics in New Jersey versus, other states, whether, a certain number of people move from New Jersey to Florida or New Jersey to Texas, I still think you're going to see a floor, if you will, exist in real estate prices because, you've got a huge portion of the population that's just in their household forming years and they haven't done it. So that's what I'm expecting to see over the next couple of years. One of the topics that I've talked about with a lot of folks that I've talked to in the industry and people on zoning boards and planning boards is about local zoning. As most of you know, New Jersey is a home rule state. So most of our zoning and planning is implemented at the local level, right? So, and, for a lot of these places and these beautiful places in New Jersey, zoning has been fairly restrictive to single family entities. So I think that's one of the topics that you're going to see come up a lot more prevalent over the next 5 to 10 years. You're going to see a lot more discussion on affordable housing, how that's going to work, where that's going to work, and probably a broader discussion, at least at the state level, has to happen around what municipalities have in terms of an obligation to deal with that. I think that local zoning and planning rules are probably the step that nobody wanted to go to in order to address the shortage of housing, because they're so diverse in terms of the regulations that apply to each municipality. But I think long term, that's one of the things that we're going to have to delve into if we want to solve the housing crisis that we've got in the United States. I would like to take last moment to thank the Maggee Miggins group, including Maggie and Leslie Crow and all the other terrific folks that invited me out. If you're interested in folks that have expert advice in Essex County, Morris County, or Union County, please feel free to give them a call anytime. And I'm thrilled that they invited me to participate in this session tonight. And at this point, I'd be happy to kind of open it up for questions, dialogue, or any sort of tirades that people want to go on regarding the real estate markets.
I would love that. And I know we do have a question and somebody has their hand up and there's something in the chat. I do have one thing, just because I've gone through all these cycles. So back in 2005 and 6, it was when the whole market crashed because of the loans, et cetera. No, as you call them, ninjas, no income, no job. Mm-hmm. So much came on at one time. And so we would see, in as much as we saw years where prices were going up 15%, 12%, and we knew that wasn't sustainable. Mm-hmm. And then the market really corrected. Your feeling is that because there's, after the crisis, they changed some of the laws, so there is more money down. So for those buyers that are sitting on the sidelines thinking, I'm going to steal a house, because they did, by the way, get to steal them back then. I promise you, there were some, and the banks were just like, let's make these deals happen. We worked a lot of foreclosure deals in our affluent towns. Mm-hmm. What do you think about that this go around, in terms of the correction in the market? You had said something about pricing going down anywhere between 0 and 10%. Is that over the next 12 months, 24 months, certain towns, certain mm-hmm. price points? The 1% is always the 1%, and we have a lot of 1% around here. So that when you look at something like that, is it in towns that are less affluent? Give me a little feeling about how you feel about that.
Yeah, one of the things that I think a lot of us didn't expect before the great financial crisis was that a jumbo mortgage could default just as easily as a conforming mortgage, that you saw defaults in neighborhoods that previously, and foreclosures in neighborhoods that you previously would never dream of seeing a foreclosure. And there's actually a lot of great literature in the real estate journals about how even having a single foreclosure on a block can wind up staying with the price action in that block for 4 or 5 years to come. So that it really is a critical component. Like I said, I think banks did tighten lending standards, so you're not going to see quite the same level of kind of liquidation value if you were to kind of go out and try to wait for the banks to just mass sell mortgages. I also don't think you're in an environment where you're going to see massive haircuts on things. I know that there's always going to be clients out there that will show you the front page of the New York Times or the Wall Street Journal saying that the markets were down 4% today. Why isn't your listing down 4%? Real estate does have a more sticky value than some other assets that you can trade. So I would say that I'm not really expecting, kind of wild swings in asset values in real estate the same way that you would see asset value swings in crypto and, NASDAQ 100, et cetera, in part because people are also using it as a shelter, right? They're using it for reasons other than just investments. So like I said, I don't think that you're going to see kind of the same, kind of mass exodus of housing where you're going to get a house at 50% of the value that it had traded at a year before. If anything, you could see some softness in the luxury space. So I would expect to see more, kind of soft, price action in luxury housing than I would necessarily in anything that's under $1 million. I think anything that can have a conforming mortgage attached to it that's in the greater New Jersey area is probably going to get a pretty strong bid, and the likelihood of you getting one of those 50% off is just not going to happen.
We do have a question. Mark says, where do you think prices are headed for that second home, vacation home, beach home properties in New Jersey? That's a great question.
Oh, that's a fantastic question. People tend to think of kind of that second home or beach home as more of a luxury item. So that's what comes out of, disposable income after you've already, purchased shelter, after you've already kind of provided food for your family. So I would have some concern about the values there, but, I am old enough to have lived through a bunch of crises that have happened, especially to New Jersey luxury second home locations like the Jersey Shore. And,
right.
There was a period post Sandy where, no one probably would have thought to have purchased, along the Jersey Shore and were concerned about, owning a home there. And then now you're at a point where the homes there, from what I can tell, just anecdotally, look like they're trading at well above where they were before the great financial crisis. So, yeah, so that market is a little bit different and has different dynamics to it, but I would not expect kind of steep declines in terms of price, even in, kind of the vacation home spots.
I do have of course, we have people that we work with all over the country, and we do have referral partners down at the Jersey Shore. And I often remember them always saying to me, people just don't reduce their house prices at the shore. They just don't do it. They rather rent it out or they'll go vacation in it. But it's, although today it was very surprising to me. I got 2 alerts up. I follow a market down there where there were 2 homes today that reduced in price. So I was very surprised for Spring Lake. I was like, that's a surprise, because normally they don't. But in this instance,
Spring Lake is considered one of the most attractive locations on the Jersey Shore, and the Victorian homes and all that are kind of near the beach area can go for just very, very heavy dollar prices. Those would probably count towards what I would consider to be the kind of higher end of the market where you might actually see some softness.
Sure.
But I think you're right. A lot of people that are owners at the Jersey Shore realize that they can rent the places out for 2 or 3 months a year and essentially cover the cost of a complete year's worth of mortgage payments. So, until that dynamic seems to go away, which it hasn't in my lifetime. So I don't expect it to go away anytime soon. I think you're still going to see some support for housing values down at the Jersey Shore.
I agree. Nancy asks us, just curious, I understand how the rates and house prices have an inverse relationship, but curious, how do rate hikes help bring down the cost of goods?
So rate hikes don't necessarily bring down the cost of goods. If anything, they increase the cost of debt for you to buy goods. So if you were buying goods and services on credit cards or whatever, your rates probably went up. If you're buying, housing, the cost of financing went up. So things that you could afford pretty easily 6 months ago or a year ago, they're a lot less affordable now. So what the Fed is trying to do with the rate hikes is to constrain demand a bit, constrain demand for different assets, whether that be, real estate, but just about any sort of asset that requires financing to it. And like I said, this has not been a normal market environment that we've been in for the last 3 or 4 years, especially. And you just saw a really radical shift right after people kind of figured out what the lay of the land was post the pandemic and decided to, kind of, this is where I want to be, or this is where I'm determining that my forever house is. So if anything, I'm more concerned about the consumer being able to afford things as inflation starts to go higher and as the cost of debt to finance any sort of goods and service purchases goes up.
She said, thank you. My good friend Ted asked, could you address the liquidity concerns in the market? And would your views change in the if the market declined by another 20%?
Another great question. There are concerns. Well, so there's concerns about liquidity in different parts of the market. So right now, I don't think that there are people that are terribly concerned about liquidity in equities or fixed income. So market liquidity from that perspective, I'm not terribly concerned about, and I'm not hearing that others are terribly concerned about that. I am hearing, though, that people are going to want to see, like I said, wider capitalization rates before they invest in certain properties, which is going to wind up, influencing price, certainly. So the second part of the question, Maggie, if you could just let me repeat it.
It says, would your views change if the market declined by another 20%?
Yeah, that's a great question. And I think that if the market were to decline another 20%, I mean, we had an event with the pandemic in March 2020, where I think the S&P 500 had declined close to 30%, at that point. And, that wound up becoming the shortest live recession I think anyone, that's been around for a few years can remember. So, I don't necessarily think that a 20% decrease, you'll see more headlines about it that might cool off the marginal buyer of real estate. But I don't expect us to go to a point where liquidity goes to nothing, where the only bids that are out there for real estate is something that's 60% of the offer price, which is, closer to what we saw during the great financial crisis.
Right. So maybe if somebody's looking, like you're saying, looking to make a deal, they might be able to go, if it's, priced correctly, it should sell. Maybe like you're saying, not 30 offers. We're still experiencing in our towns where we sell, we are still experiencing, if something's priced appropriately, there are still multiple bid situations happening. Mm-hmm. And I think, I always say to the agents that work on our team, the pretty girl always gets asked to the dance first. So the pretty girls get sold first, the ones that require a little more work, mm-hmm. Seem to take a little bit while longer. One of the nice things about the company we happen to work for is Compass, is they have a concierge program that you can borrow money from them interest-free to fix your home if you want to stage it, or if you want to, just pretty it up a little bit. And then you just pay the loan back at the closing. So that does help, because a lot of the times with the way the banks are, people have to put down a certain amount of money. So if they're looking at $1 million house and they're putting down $200,000, we'll say 20%, or even 25%, they might not necessarily have the money to paint and fix. They're just, scraping by and eating peanut butter and jelly sandwiches till they can start, making a little more money and whatever they need to do to buy their first home. So I think those are good products to look at as well. People should ask us about Compass Concierge if they're thinking about moving.
And definitely, like with the change, and you probably know this, not just from talking to buyers who might be in their 20s and 30s, but buyers in their 40s and 50s also. They go online first to look at properties. They look at pictures of the properties and kind of pre-screen what they're going to look for. And if things don't look like they're in move-in condition, that's going to influence a buyer's perspective on whether or not they even want to see the property. So, I think most folks that are involved in real estate will tell you that if, usually, throwing new paint on, doing a staging is money well spent because it winds up coming back to you in the purchase price. I know there have been lots of studies about whether it's a kitchen renovation or things like that. That's all up to really the seller in terms of how much work or how much of a project they want to do before trying to move on. But there are some things that, even sellers that don't have a ton of capital to put into it should be considering, before they list a property.
Right. And, in the state of New Jersey, I don't know if people know this or not, but in the state of New Jersey, they've changed the laws so that if you want to do, say, a kitchen renovation, adding new cabinets and new countertops and a backsplash, or you want to do the same thing in your bathrooms, as long as you're not moving plumbing or electric, you can do it without a permit. We put a roof on, and I'm very careful. I pull permits for everything. We put a roof on. We didn't change anything because as real estate agents, we're you're really held to a higher standard. We didn't have to pull a permit to put the roof on. Rob asks, hi Steve, considering the 1-year T-bill is above 3% and the spread, between this rate and national multifamily caps is tightening rapidly, how vulnerable do you believe rental growth assumptions are as we've seen rental inflation skyrocket across the board?
Yeah, great question, Rob. I know Rob is very active in real estate markets. He actually works for a real estate data analytics company that many of you have probably heard of. Great questions. So with the 1-year T rate above, kind of hitting the 3% level and how it applies to multifamily caps, I think what I was hearing anyway is that multifamily cap rates have to back off at a minimum another 50 basis points before it even starts getting attractive to some of the portfolio lenders that are out there. So, instead of 475 or 450, you really need to see like a 5 or a 550 before things start to get interesting for them. In terms of rent growth, I think that there's there's a number of, kind of great calculators out there between like the rent or buy decision, because usually those numbers can't become too far untethered from one another. Usually the decision on you could either buy a place or you could wind up renting it. You usually won't see those get too far out of whack, compared to one another. So we have seen really fast rental growth, particularly in New York City and kind of certain pockets of that market. But I don't think you've seen really fast rental growth in most of the rest of the places in like New Jersey, even suburban New Jersey. Rentals do tend to take some time. Just about all leases are 1-year leases. Some of them are 2-year leases or more. So it can take some time for price action to start to filter into leases. So I would expect to see rental growth to continue for the next 6 months, if for no other reason that we're still kind of facing a backlog related to people being able to rent the place that they want and the location that they want for the price that they want. And I think you're going to still see some dislocation there. But terrific question from Rob.
By the way, we're seeing rental prices, bidding wars going on rentals. Right? It's just, who's used to that? We are. They're absolutely going over.
Right. I mean, if you've just spent the last 12 months in the real estate market looking for a home, and I know I've heard stories from a number of folks that have been out there and they've lost 8 or 9 different bidding wars. Where do you turn? You have to be able to find housing and some place that allows you to commute to work and to raise your family, et cetera. So folks will turn to the rental market, and that's going to wind up having an inflationary spike to rental values. So Rob, raised a great point, which is that how much can you really bank on those, kind of increases in rental values? For the next 6 to 12 months, at least, I think you can still bank on some sort of increases in rental prices, at least from what I'm hearing from folks that are in the industry.
I have one last question for you.
Shoot.
So many of our clients, COVID hit, that's it. We don't need to be here anymore. We're moving out to Pennsylvania. We only have to commute in 1 day a week, blah, 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 all that stuff. All of a sudden, gas prices are through the roof.
Mhm.
Your company decides that, you know what, we want you in more than 1 day a week because Maggee, you know what, I know you want to come in 1 day a week, but Susie over here, she's willing to take your job and come in 5 days a week. So we're going to need you to come back into, how do you think that impacts real estate, say in this like tri-state area? A lot of our people went out to Pennsylvania, they like the taxes better there, et cetera, et cetera. What do you think happens with those people? And our real estate then impacting that coming back in?
Yeah, I think you're going to see more return to office than people are pricing in currently. People are currently, kind of pricing in, maybe they're going in 1 or 2 days a week. I could see a point 5 years from now when most employers, at least in the New York City area, are asking for 4 days a week. So it wouldn't surprise me if at least some of the major employers started going back to the office. There's some, kind of jobs in industries, whether it be tech or others, that can deal with, more of a remote workforce. I think it was either Facebook or Google, or one of them that said, basically all of our employees can be remote. And that's fine. And you can live, a nice lifestyle in central Pennsylvania with, a more affordable house. But then, a lot of people will do that trade and then realize, well, is this the community that I wanted to live in? Is this the place that's kind of connecting me to my family? Is this the place that's allowing me, to kind of get out and socialize and participate in the community the way that I want to? And I think you are going to see a number of boomerang folks that thought it was a good idea to move out to the country and then wound up saying, maybe I'll go back to the suburbs or kind of closer into the urban area.
Right. Awesome. Well, it is 8:05. We are so grateful to you, Steve. This was such an amazing hour. I just want to thank you so much for all that you shared with us. I hope everybody that was on the Zoom call enjoyed it. If you have any questions, please don't hesitate to email us. If you have any questions for Steven, we'll be more than happy to get them to him as well. This was wonderful. This was really enjoyable, and it kind of put everything in a little bit in perspective for all of us. And I look forward to doing this with you again. Let's maybe in 3 months or so see how wild this. Nobody could have predicted COVID. Nobody could have predicted the Ukraine. Let's see what happens. Hopefully things start to normalize over the next 3 months. But thank you so very much. It was such a pleasure having you. I hope everybody got something out of this. We're going to send out a recording if you wish. We'll have a survey. Would you do me a favor? Please fill it in so we know what you liked, what you didn't like, what we could do better, what you'd like to see again. And it would be our pleasure to be able to share that with everyone. Thank you so much. Have a lovely evening.
Great. Thanks, everyone.
Thanks so much. Take care.